Welcome back to IC38 learning module sessions. Let's start with the chapter 1. Moving forward, friends, there are about 9 chapters in the life insurance segment in our IC38 examination. The first chapter involves with life insurance. The content says what life insurance involves, and it will be followed by financial planning, life insurance products, traditional life insurance products, non-traditional, application of life insurance, pricing and valuation in life insurance documentation, life insurance underwriting, and life insurance claims. You can be rest assured, once you focus learning these contents, it will be useful for you for the entire journey as a life insurance professional, rather than focusing only on the examination point of view. You can the intent is to ensure that you learn the contents, you see the Q&A, so that you complete the first step successfully, which is passing your IRDA examination. So let's move into learning what life insurance involves. So the first chapter is what life insurance involves. Right. The let's see this chapter as 5 basic parts. Right. So the 5 important components will be introduced to you about life insurance. The asset, which is the human, how to define the human life value. Right. So risk and life insurance, how it is seen as far as the proposals and policies are concerned. What is level premium? We will know about what is risk pooling and life insurance contract. So you can have a look at the 5 important components of life insurance, which is human life value, risk and life insurance, level premium, risk pooling, and life insurance contract. Let us learn more about each one of these important components, and let's start with the human life value. For both the properties and life, there is always a monetary value which has to be attached to the policy. So the monetary value, ascertaining the monetary value is key in giving a policy to a individual or a property. So ascertaining the value of a property is easier because there is always a tag to every property, every asset we purchase. But how do we give a insurance value to a human life? So there is a method which was introduced by Professor Hubner almost 70 years ago, and it is known as human life value, and it is used even now worldwide. Right. So how do we go about calculating a human life value? Let me explain to you with example here. Consider our customer, Mr. Rajan. He is earning 1,20,000 a year, and he is spending 24,000 rupees on his own, on himself. Right. So that means 96,000 is what he is spending for his family. So this is one number which you have to arrive at. What is the dependency of the family on this individual on an annual basis? So here in this case, Mr. Rajan's family gets 96,000 from him every year. If you assume that the rate of interest is 8%, and how do I arrive a human life value? Very simple. The total annual contribution by the individual to his dependents divided by the rate of interest. In our example, it is 96,000 divided by 8% interest, which is 12 lakhs. So for Mr. Rajan, the ideal sum assured, the ideal insurance value recommended will be 12 lakhs. So this is how you arrive at a human life value. So what happens is, using this method, once the individual takes up right life cover, the family will be protected, and the economic loss will be taken care, and there, in case there is an uncertain death of the individual. So this is human life value calculation for you. Right. So moving to the second component of the life insurance, which is risk and life insurance. So insurance as a concept arrives because there is a risk which is existing. So how do we tackle that risk? What is the recommendations we do? So that is what this content speaks about. This topic speaks about. So there are three situations where a risk can occur, which is dying too early, living too long, or a living with disability. So for every aspect there is a life insurance solution which is existing. So to break the myth that life insurance will be useful only after death, you can always use this topic to discuss, telling that insurance as a concept covers three different risks, which is dying too early, living too long, and living with disability. What is dying too early? This area of risk is the premature death which we are referring to. For instance, if in a country the average age of a person dying is about 75 or 80, right? In case if the death happens to this person during the peak of his working age, for instance at 35, then it is dying too early, right? So what is the second risk here? Living too long. You're planning your expected life is till the age of 75, and if the person lives till the age of 95, that becomes living too long. So how do we cover these? Dying too early, you will see in the following chapters about life insurance products, where for every area of risk we can recommend a solution to the customer, right? So moving forward, living with disability is the third risk involved. It is neither dying nor living too long, but it is living with a disability. There is an unexpected accident happening, and the customer loses his limbs, then it becomes he is living with disability. Do we have any solutions to cover this risk also? Yes, we do, and you will know about this in the following chapters where we speak about the life insurance products. So in the first chapter we are discussing 5 components of life insurance. We have seen the first one, human life value, and the second one is what are all the risks we are covering in life insurance. So I'm just trying to give a little comparison here between general insurance and a life insurance, and how the risk is ascertained. For instance, in general insurance we use the term indemnity. What is compensated? Whatever is the loss is being compensated. For instance, there is a fire in a godown, whatever is the loss faced by the owner because of the fire has to be proved, and that will be given as a insurance claim. Wherein in life insurance we use the term assurance. What is this assurance? While the agreement is done between the life insurance company and the individual itself, we say that in case if there is a death happening, we will give this sum assured to your nominee. So the two different terminologies introduced here, indemnity and assurance, right? So what is the duration? In general insurance it is usually a short duration product. It is 1 year renewable, or a short period is given. Wherein in life insurance definitely it is a long duration product, and every year a renewal premium has to be paid. Moving forward, continuing with understanding the difference between general insurance, life insurance, both the insurance aspect, for instance general and life, will take care of an uncertainty, right? So uncertainty in both the cases. For instance, in life insurance death is uncertain, and in general insurance the risk, for instance an accident or a fire, is uncertain, right? So moving forward, just to add a few more points, there is an increase of probability. How is the increase of probability of event by time, right? By time in life insurance we know that by age increases, the probability, the increase of risk, which is death, increases. Wherein in general insurance contract there is no specific risk in increase, be it accident, earthquake, fire. There is no specific increase by the time of the policy. Okay, so we saw differences between general insurance and life insurance. Let's move into the next component of the life insurance, which is nature of life insurance risk. Right, so it is very easily understood when we speak. When the age increases, the probability of death increases. So lower premiums are charged for people who enter the contract at a younger age, wherein the premiums will be higher for people who are coming when they are older. So moving forward, let me introduce you to a concept called level premium in life insurance. Somebody gets into a contract, and the premium which is charged to the customer across the entire term of the policy is the same. That this concept is called the level premium. So it is very clearly understood that somebody who is at an younger age gets into a contract, the premium will be lower, and he will be paying the premium which is level, same across the entire term. Right. Just to give a little bit more briefing on what is level premiums. So we collect, for instance, an X value as premium across a term of 30 years of a policy. So it is very clear that the first 15 years, when the age is younger, he may be paying a higher premium compared to his age, which will compensate to the premium which will be collected when his age is older in the second half. So he will be paying a lower premium as far as the age is concerned during the second half. Not to confuse ourselves with a first half and a second half example. Concept is very clear. Premiums are level premium, means same premium across the entire term. Right. Lastly, let's speak about risk pooling. Risk pooling is the concept is very simple. There are 10 people, 20 people, 100 people, 1000 people in a group, and let's assume an example of 1000 people in a group. Each one of them pool a money of 10 rupees. That means there will be a collection of 1000 into 10, which is 10,000 rupees, and the group decides that in case there is a death of an individual in the group of 1000, right, so they will pay 100 rupees, 500 rupees to that family. So this is risk pooling, a group of people coming together, contributing small money, taking care of the risk to be faced by few people in the group, and this money will be paid to those people. Right, so this is risk pooling as a concept. Right, so let's get into life insurance contract. Right, so the policy document is the actual contract between the life insurance company and the customer. So what is the most important document in a life insurance contract? It is the policy document. The details of all the terms and conditions of the product taken is mentioned in the life insurance contract, which is the policy document. Right, there is a mention about the sum insured, there is a mention about the guarantees given in the product. So what is the guarantees? For instance, if the life insurance company gives a guarantee telling that a sum assured will be paid to the nominee due to uncertain death of the policy holder, so that will be honored by the life insurance company when there is a death of the policy holder. The regulatory body is very strong, and a strict supervision is existing to take care of such guarantees are honored by life insurance company. Right, so quickly moving forward, the advantages of life insurance contract. There is a disciplined savings which is introduced. The saving is safe and secure. It frees the individual from the burden of taking loans in future. There is a bit of liquidity available, and there are tax benefits existing when we speak now, and safe from a creditor's claim. So a life insurance contract comes with these advantages, and let us also see the flip side. Flip side is what can be the disadvantages of a life insurance contract. It can be affected by inflation. Right, the yield are lesser compared to the other tools, and lastly, less cash value accumulated in the initial phase of the term. Right, so we spoke about the 5 components of life insurance. which is the first chapter of IC38 modules. Keep learning. Continue to watch the Q&A video of this particular chapter, right? So that you get an idea of how the questions are being asked from this specific chapter. So let's continue with the second chapter, right? So before we go into it, I would urge have a look at the Q&A video of the first chapter to understand the sample questions. So happy learning, and not to miss, I am reiterating, in addition to watching this video and understanding the basic concepts, I would urge you to refer to the study material of IC38 and prepare well in focusing the examination, right? So good luck, happy learning.